Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
I'm Whitney, host of the Real Estate Syndication Show. Every day, I'm interviewing experts that will help you to successfully invest in or grow your syndication business. Hit the like and subscribe button so you'll be on track to learn from the best in the industry. Hey guys, it's Whitney. I wanted to take some time to introduce you to my good friends over at PassiveInvesting.com. They're a national private equity real estate firm based out of the Carolinas. They focus on acquiring institutional quality apartments and self-storage facilities. They do this with private accredited investor funds. They have a portfolio of over $700 million in assets and control over $250 million in equity from their investors. PassiveInvesting.com makes it easy for you to start investing in real estate without all the hassles. They even have an average 62% repeat investor rate in each offering they put together. They even have a real estate debt fund that offers hard money loans to local fix and flippers across the U.S., which currently has a 0% default rate. To help you learn more, they've put together a free passive investor guide that outlines the 7 red flags for passive apartment and self-storage investing. Visit PassiveInvesting.com/red flags to download the PDF now. That's PassiveInvesting.com/red flags.
This is your daily real estate syndication show. I'm your host, David Robinson. Today, our guest is Jae Park. Jae, welcome to the show. Thanks for spending some time with us.
Thanks for having me, David. I'm looking forward to being on the show.
So Jae currently manages the acquisitions team at Open Door Capital and oversees lead generation, underwriting, and due diligence. Prior to Open Door Capital, he was part of the global strategy team at Uber in San Francisco. He has a chemical engineering background with a minor in business, and he specializes on the underwriting side of mobile home park acquisitions. And so we're excited to dive into some detail about his role with Open Door Capital. But before we do, Jae, we would love to hear a little bit more about your background and how you got into this space. So if you can, just back up and tell us a little bit about that.
Yeah, definitely. Appreciate the quick intro. So just take a step back. When I first started off, as you mentioned, as an engineering background, I studied chemical engineering in school, and I worked in oil and gas for a few summers. I thought that's what I really wanted to do back a few years. And I eventually made the transition and to go work in the tech industry. So I went to go work at Uber when I was a private company. And really, my real estate journey started with a coworker of mine. And she was a project lead in an assignment that I was on. And she was a real estate investor out of the Bay Area. She had a few rentals and made some investments in real estate. And she actually recommended some business books and podcasts. You know, one of the podcasts was, which I'm sure several of your listeners know as well, it's called the Bigger Pockets podcast. So I just started chewing through a ton of content, just reading books and podcasts. And there was an opportunity through Open Door Capital, as I was following Brandon Turner on Instagram, to join the team part-time basis, just helping out as they're scaling and growing. And I first came in through mostly an underwriting function for the team about a year ago now. And, just really got to know the team, worked for a few months. And after a few months, I was actually looking to transition out of Uber for that time. And then a full-time opportunity at Open Door came up. And so I felt it was like a natural, good transition. I joined the team, and it's been a little bit more than a year now. It's been a good ride. So it's been fun.
Well, that's great. What was that process like getting started with them as a part-time underwriter and then the transition to full-time? What was that process like for you?
It's kind of totally random, but I actually saw the posting on Brandon's Instagram. It was when I was visiting my parents in Houston. I had left San Francisco since everything went remote during COVID. And so I was just on my phone a lot more. I was browsing Instagram, and I just kind of came on that post, and there was like an application process and test process. We went through several tests, probably 5 or so tests, they're very position specific. It would ask about kind of your financial background, what's your experience in real estate, how do you analyze deals and things like that. And kind of did several of those tests. And I'm sure we've had probably hundreds of applicants back then. And luckily enough, I was the one that, had the opportunity to come work for the team. And so it was a smaller team back then too. So when I came on board, it was Walker Meadows and Ryan Murdoch, who were mostly running acquisitions at that point. And just kind of, I got involved with them, and it was kind of, they're just trying to teach as much as they can, showing their model. And we make some improvements to our process and systems, and just absorb by actually just being in the weeds and underwriting deals and reviewing deals, like hundreds of deals over the course of a few months. So got my experience that way. And really, I think we just both got to know each other a lot better. I got to know the Open Door Capital team, the group of people that we have, and then they got to know me as well, just by working for a few months. And there was no expectation. It was like a true part-time. I had a full-time job at Uber. I liked what I was doing there, and they needed some help. So it was a mutual relationship. And it's just when, towards my end of my Uber time, I was looking for a transition into real estate as I got more involved, and they had an opening that opened up. So it was more of like a natural transition at that point.
Oh, that's great. Yeah, thanks for shedding some light on that. That's an interesting way to enter into the business for sure. So describe for us, and we did a little bit of that in the bio, but describe for us what your role looks like with the Open Door team and what a day in the life of Jae looks like, if you don't mind.
Yeah. So I would say it's really managing the acquisition process right now. And I would say you can break it down into three core functions. One is lead generation. So it's finding deals. And that could be talking to brokers, wholesalers, talking to sellers directly just to find deals. Second part would be analysis. So that would be on the more of the underwriting side, analyzing the deals and stuff like that. And the third bucket, I think of it as due diligence, which is once you get a deal in the contract, you're getting it all the way to the closing table, making sure the deal, what you thought it was like on paper, is still what it's looking like when you actually go to a property, do all your due diligence, review materials. It's still the same similar deal that you like. So those are the three core functions that I manage right now. And our team right now is about 3 or 4 people. We have some help underwriting deals right now. So I'm spending more of my time kind of tweaking the underwriting model and managing that process, and also spending a lot of time on building relationships and maintaining relationships with our deal finders, which should be primarily brokers and wholesalers.
Well, I appreciate you breaking it down into those 3 categories: the lead generation side, the analysis, and the due diligence. Why don't we just sort of tackle all 3 of those and dive a little bit deeper into each one of those aspects? I'll start with lead generation. You're in the mobile home park space, or at least that's a significant focus of what you guys are doing. Talk to us a little bit about the strategies or tactics that you're executing on to find good opportunities in the market today. And especially as it seems the multifamily space has started to become quite saturated, and you have a lot of would-be multifamily investors that are transitioning into the mobile home park space because they can find better yield. Maybe talk to us about A, strategies and tactics, and B, the impact of sort of this migration into the mobile home park space.
Yeah, I would say, just to start with the tactics, you need to have a really crystal clear criteria. And that's kind of how we derive from. We first define our criteria. For example, for us, we're going to buy 90 plus pads, and then public utilities, 100,000 people in 15-mile radius, and several other bullets that we share with everyone we talk to. And so you think of kind of the deals that exist in the mobile home park space that fit that criteria. I would say there's probably about 40,000 mobile home parks in the US, and the deals that we're looking for are probably in the low thousands range, maybe even high a couple hundred. So they're far and few between. So that kind of drives your deal finding strategy as well, because the owners who own those type of assets could be a different type of seller than someone who owns like a 10 pad mobile home park in a smaller metro. So we kind of, that criteria really drives our acquisition strategy as well. And so for us, we break it down into kind of 2 categories. One is off market and on market. On market would be typically what you see on listings, like listed by brokers, email blast, Crexy, LoopNet, mobilehomeparkstore.net. And you can find good deals that way. And we've actually found deals that way too. We found a deal on Facebook Marketplace one time. And that was like a 150 plus pad park, but those are far and few between. But you can find deals that way too. Primarily how we're finding deals right now is the off market, which a lot of the time can be broken down into, even brokers can bring you a ton of off market deals. A lot of brokers have really strong relationships with owners who could be bigger groups just like us. And maybe the group, for some reason or other, don't want to list their property fully. They just want to send it to 5 buyers, for example, just to keep it kind of under the rugs and quiet. And so they don't want to upset anybody, see what kind of price they get. So we get a lot of, those are kind of, we call that in the industry just pocket listings. So we get a lot of pocket listings, first shot at deals, just because we've done deals with them. And so that's one. And the second I would say is wholesalers too. And wholesalers are people who are really, they have a database of mobile home parks that they built over time. They call sellers, they have relationships with sellers and owners, and then they kind of have either they get the deal in their contract and get an assignment fee that way by taking the difference, or they just send the lead to us, and then but at the time we close on the deal, we pay them an assignment fee, a wholesaler's fee, stuff like that. So they can make money that way.
To ask a follow-up question in regard to that, obviously one of the founders of the team, Brandon Turner, very well known for his role with Bigger Pockets. He clearly has a large social media presence. And if I remember correctly, there was a point in time where he was encouraging, people to be out there hunting for deals and bringing them to the team. Is that part of the model for the wholesalers? Is that how you've attracted the wholesalers to bring those deals to you?
Yeah, that's right. We actually, and that's the key benefit of having Brandon kind of as a large following.
Absolutely.
We actually call that bring Brandon a deal. So and it's still part of our lead gen funnel as well. And we have a website called Bring Brandon a Deal. You guys can check out the site. There's a video of Brandon kind of explaining what we're looking for and what the process looks like, how to submit a lead to us so it comes to our team and it gets tagged correctly so we can review it. And,
interesting.
He would just kind of post on his Instagram. It's like, Bring Brandon a Deal. This is what we're looking for. We used to do some webinars explaining to people and how to even find deals and things like that. And that was a solid funnel for us. We probably reviewed, we got hundreds of leads that way as well. And it's very similar to a wholesale model where it's really assignment fee based. And so for us, our promotion right now is you bring us a deal that fit our criteria, we would pay you $100,000 at closing. And so there's a lot of interest for that as well. And that's like a unique part of our acquisition strategy as well.
Well, before we move on to analysis, is there on the horizon, or do you see any strategies that maybe are unique that you haven't tested out in the past that you guys are looking to, potentially deploy?
In terms of just in the MH space?
Lead generation. Yeah. And the mobile generation. Home. Yeah.
I would say ours really is not about strategy per se. I think it's more systems based, and we're kind of testing it out too. We've been in the space for a few years now, and we've really built relationship with all the main brokers and I feel like all the main wholesalers. And what we're now trying to get better at is trying to apply the 80-20 principle a little bit more data driven. And, similar to the multifamily space, you have a few brokerage firms that are doing, you could have a 20% brokerage firms for the brokerage firms that could be doing 80% of the volume in the entire space. From the MH side, it's actually more concentrated based on our data. You probably have 5 groups that are doing 90% of the deal volume just based on size. So we're really trying to put a lot more effort in maintaining and building a stronger relationship with those groups that manage a vast majority of our transactions. And so we can get deals that way. And so that could just be being super easy to work with, right? Like we've had deals, we find stuff and we really try to keep our words. Like, hey, we found this deal and this is going to cost us this much, but we really value our relationship with you guys. We're just going to move on. And, hopefully the next deal we can make up for it that way. So we really try to have, like a really long-term vision. This is a relationship we're trying to maintain for a long time and continue to do business together.
Yeah.
Or it could be just like a cool gift. We could send them at closing, like a surfboard if we signed that this guy likes to go surfing and things like that. So we just try to stay on top of mind. There's actually a book called Blue Fishing, by Steve Sims, which I highly recommend. It's kind of like, how can you stand out? And the lesson that we learned from that book is people really remember the highs and the lows. They rarely remember the average day to day. So, Steve Sims would, when he was traveling somewhere, he would just be in a hotel room. He would rip a magazine and write a little note to one of his clients and just ship that little cutout magazine in the mail. And your client gets that and they're like, wow, this is like, I've never gotten something like this before. Just
interesting.
So just trying to stand out that way too.
Yeah.
Happening on January 20th and 21st is Denver's biggest real estate event, the Next Big Thing. And it's shaking up how real estate professionals will define business success. This 2-day event will give you tools so you can catapult your own business. You'll discuss how the world is changing and what's needed to stay 2 steps ahead. Together with 450 other professionals, you will build a foundation to become the next big thing. Built on the foundation of helping others build wealth through real estate, the Ruth team has created the ultimate tool that is this event. And it's called The Next Big Thing. 25 speakers, including Ryan Serhant, Kenyon Salo, Nebu Hatta, Stacy Veeden, Brian Moses, Natalie Davis, and Ryan Avery. Register now at thenextbigthingcolorado.com and use the code RESS to get $150 off.
As it relates to direct to seller, because really by tapping into brokers, you're sort of a second level down from direct to seller, right? Because the brokers are doing that work of staying in contact with the seller. Why not be more aggressive with direct to seller and play that role with these sellers versus working with the brokers directly?
I would say we are active in direct to sellers too. We actually closed in a deal a few months ago that was direct to seller. It was another group that owns a ton of mobile home parks, and we had actually bought a park in the same metro. And every time we close in a deal, we do an email blast to our list just to say, hey, we closed this deal and this is our criteria, just to kind of reiterate that. And the seller saw that and then reached out to us actually. Like, hey, I have a park in that metro I'd love to sell. And that was very direct to seller, just us, and we closed that deal. So it's a strategy that works and that we implement. But, if you think about it from a seller's perspective too, is there's also, when you're working with brokers, there's a level of representation that brokers do as well. And some sellers value that. So actually some sellers, they don't want to do direct to buyer transaction. They want to go through brokers because they kind of help the process and there's representation from the broker. So I think it kind of depends.
Yeah. Well, I think that's a great point. And, regardless of how deep or heavy you wanted to go with your direct to seller efforts, there's going to be some that you just can't connect with simply because they want an intermediary to help with the deal. Yeah.
Right.
All right. Well, before we move on to analysis, I did want to ask you about whether or not you felt like there's been any, from a lead generation and an acquisitions perspective, if there's been any challenges as you see more and more would-be multifamily investors that are sort of migrating into the mobile home park space because they see opportunity. Have you noticed any challenges that have come from that?
Yeah, definitely. I would say a lot of people in the real estate industry in general are feeling cap rate compression. And just because you kind of have these bigger buyers coming to the space and searching for yield. And so we're seeing that in the mobile home park space too. If you look at mobile home park space just a few years ago, cap rates are probably 200 to 300 bips higher than it is today. And so just in the last few years, we've seen a significant amount of new entrants into the market from different asset classes that like the supply and demand mechanics of mobile home park space, and they like the yield. So it kind of drives down cap rates and increases pricing. So we just need to be true to our fundamentals. That's why you need to have crystal clear criteria. We want to be the best in the mobile home park space that buy 90 plus pads, public utilities that fit our criteria. Those criteria were really defined from us reviewing a ton of deals, and based on our return structure, those are the deals we can be very competitive on price and we can win those deals. So I would say it just comes back kind of to your criteria as well. And also trying to get a good sense of the market as well. We like to look at who are the other buyers that we're competing with and how are they structuring their fund, their syndication and things like that. Are we comparable to how they're structuring deals and things like that? So not only you want to have a crystal clear criteria so you can really get good at what you're doing and going a mile deep, but also you want to stay on top of the market and what things are changing so you can adapt.
Yeah. Love it. Love it. Well, let's talk about analysis real quick. So once you have a deal, maybe just talk to us about your process, your internal process from a mechanics perspective. And then maybe let's dive into some tips and strategies or mistakes that you see or common mistakes in underwriting and analyzing mobile home park deals. So maybe start with the mechanics of workflow as a deal comes into your pipeline.
Yeah. So we use a tool called Asana, which is a workflow management tool. And quick fact I like to throw out is for every 100 leads, 100 deals that we look at, we probably only underwrite 10 of them. So you're getting 100 leads, but you're only really looking at 10 deals deeply. And so it's like this big funnel we're trying to build. And that's why we spend so much time generating leads, because we know most of them don't make it through that funnel. So it's like a 3-step process that we filter really. Is the first step is we have such a clear criteria. A lot of times we can just glance at the deal for a minute or two and immediately no go, or this is worth looking into further. That could be based on size, potential purchase price, other type of criteria that we've developed. So that's our first funnel. The second funnel is we have a quick tool with quick rough financial model that we've built out that can kind of look at where we think this park should be valued right now compared to the price, and where we think the value could be after we make improvements without fully underwriting the deal. And so that's a next level of funnel that we do. Then we can very easily tell if the pricing's way off or it's a little too stabilized for us to hit our returns. So that's the next funnel that probably weeds out the vast majority of deals. And then the remaining 10 or 15 or so deals that go through that funnel, we actually fully underwrite the deal. So we have a model that we've built out in-house that we use for every single one of our deals. And once the deals makes it to that, we generally know we're going to make an offer in the deal and we're going to be generally competitive on price. And so those are the 3-step funnel. And obviously after that, you would make an offer. So there's a lot of effort that we put in just to build that funnel and maintain that funnel.
Yeah, love it. Thank you for walking us through that. So let's talk a little bit about some of the common mistakes that you see made by operators that are underwriting mobile home park deals. Where are those mistakes made?
Yeah, I would say the first and foremost is mobile home parks generally have a couple things going on. It's generally mobile home parks, it's this land, you have utilities running and you got pads, and you could have different things. We've seen single family homes on the park. We've seen apartments on the park, like self-storage units. But in generally, mobile home park valuation is 2 parts. One, the valuation is you look at just the lots. You look at you call it the land, the lots. So the land generates some kind of income, which is from the lot rent, we call it. And so that is valued differently than, for sometimes the park could own several homes. We call those park-owned homes. And, lenders and buyers value those completely differently. So if the land generates a certain amount of income, then we apply a cap rate to come up with a value to that. But if the owner has some homes in the park and they're generating some rent on top of the lot rent, for example, then that doesn't get applied a cap rate. So that's a common mistake we see some operators do, is they take the whole gross income with a bunch of park owners, apply a cap rate and come up with a valuation, and we see them overpaying and making mistakes that way.
And are you looking for exclusively tenant-owned homes on these parks? And what happens if you find a deal where you have a significant number of park-owned homes?
Yeah, so that's one of our criteria too that we build out, is we want to be buying parks that have less than 25% park-owned homes. And the reason is tenant-owned homes generally tend to be longer-term tenants and lower maintenance. because the tenants own the homes, there's very little, you're not going in there fixing their toilets, maintaining the homes, or doing repairs and maintenance on the homes. If you were to own a rental unit, for example, then really it's just a lower operational expense business, less headache, less management. So we love that part. So we try to target less than 25% park-owned homes. Doesn't mean we make exceptions to that. It's not an automatic no-go. If we like the other aspects of the deal, then we would be more lenient on that criteria. But generally, we'd like to stay under 25% park-owned homes.
And so the first sort of tip or strategy in underwriting these deals is to look at the lots independently and apply a cap rate to that and value that out versus applying the entire income that's being generated from both the lots and from the homes.
Right. Because one example is, let's say your lot rent is $300 a month. You multiply that by 12, that's $3,600 a month. And then let's say it's a 10 cap. That's $36,000 that you're valuing, that home, for example. Whereas a park-owned home, if it's an old model, it could be $10,000. So that right there is a 3x multiple you're giving on the value if you treat the income from those homes the same. So that's why you can easily see the more park-owned homes you have and you value them incorrectly, you can grossly overvalue the property.
Yeah, love that tip. Any other common mistakes that you see made when underwriting mobile home parks?
I would say the next one really is, I see our operators kind of blindly using expense ratios a lot of times. And it really kind of stems from the fact that they just want to kind of do a quick back of the envelope math. So for example, they could use, all right, I'm going to use a 45% expense ratio and then, just carry that throughout the whole term. I've seen that do that. But the reality is, as you're making improvements to the park, bringing in new homes to increase occupancy, increasing rents after improving the property, your income is going to grow at a faster rate than your expenses. So if you keep the same 45% expense ratio throughout the whole term, you're assuming that expense is going to grow at the same rate as your income is growing. So then you're undervaluing the property eventually. So I've seen that too. So I would say, you can't just blindly apply an expense ratio on every single deal. You actually have to look at what the expenses are.
Yeah, love that. Well, for the sake of time, we're going to forego the due diligence piece, but any other advice or strategies or tips that you could share with our listeners as it relates to lead generation or underwriting that might be helpful to them?
I would say you're going to work with several different people. It's a team business, but one of the biggest, most important thing is going to be your lender, because you're going to underwrite to a certain type of debt and stuff like that. So make sure you build a strong relationship with banks or a mortgage broker, for example, and make sure you have a very good idea of how the lender would view the property, because the lender could view the property differently from how an operator could view the property, and they very well underwrite it differently, slightly differently. And so make sure you're very clear on what kind of debt you can get before you even make the offer. That way you find out you can't get that debt or those terms, you're not in a sticky position where your returns drop dramatically and you're like, okay, can we do this deal at that point? Then you're in a very sticky position. So you want to be, by the time you make an offer, you want to be very firm on your financing strategy as well.
Yeah, great advice. Having a tight lender relationship and really understanding their criteria and how they're going to underwrite the deal and make sure that you're in alignment. Yeah, critical. Jae, I've really enjoyed our conversation. You've shared a lot of great insight. I want to start winding down here. Got a few questions for you before we end the show. The first is, what's some daily habits that you've developed that have helped you to be successful?
That's a good question. I would say this is not even work related, but I just like to get my body moving and exercise in the morning. And because I think part of the thing about remote working too is it's so easy to be always working and like being attached to your work, because there's no separation between your office, your office and bedroom. So I like to try to keep that separate. I try to have my work set up separately from my bedroom, totally separate. And I also like to just get out and get a workout in and before the work starts. But also what I would say is I like to plan my days before the actual day starts. So the night before, the evening before, after work, I would plan out what I want to do the next day. And then, Sundays, I would plan out for the week. And then every day you kind of have new stuff come up. So you tweak it a little bit. But I would say the planning for that day actually starts the night before.
Yeah, I found the same thing. Those two things, sort of getting clear the night before on what you're going to execute on the following day, and getting up and getting after it, get your body moving, working out. That's great. Last question for you before we end. What are some ways that you and your team are preparing for a potential downturn in the future?
That's a very good question. I'm sure a lot of your listeners kind of have that in their mind too. I would say that's one of the reasons why we like the MH space as well. Because before we even decided to go into this asset class, we looked at several different asset classes and we compare it to how did all these asset classes perform in a downturn, like in the 2008 crisis and things like that. And we looked at asset classes that performed very well during that asset class. And mobile home park space was one of the asset classes that were one of the top performers in that asset classes. So that we kind of know just from historical evidence, the strength and resilience of the asset class as well. And another way to do that is to, really staying true to your underwriting fundamentals. You're going to be in situations where you're going to have other buyers who can just pay a lot more than you can pay. And maybe they're underwriting the deal a completely different way. Either you're not underwriting the deal correctly, or the other group could be underwriting way too aggressively to win that deal. So I would say stay true to your fundamentals, stay conservative. So when in time the downturn happens, you have room in your underwriting to make up for that difference and still have a successful exit.
Love it. Great advice. Well, Jae, it's been a pleasure to have you on the show. Thanks for sharing a little bit about your journey in working for Uber on the global strategy team there, and your really natural transition into the real estate space and working with Open Door Capital. And thanks for sharing some of your strategies and tips and tactics as it relates to lead generation and analyzing and underwriting mobile home parks. What's the best way for our listeners to connect with you and learn more about what you and your team have going on?
Yeah, definitely. I would say our website for the company is odcfund.com. That's odcfund.com. Personally, my email address is jae@odc.com. That's just my first name. I can also be reached out on social media like Facebook and Instagram and also LinkedIn. So feel free to shoot me an email or reach out on social media just to reach out if you have any questions about the space. Happy to jump on a quick call.
And we'll have linked to those in the show notes. Jae, again, thanks for coming on and thanks for sharing some of these strategies with our listeners, and look forward to connecting with you again down the road.
Absolutely. Thanks for having me, David.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.